How's it going, everyone? Matt Leighton, welcome back to another video. In today's video, we're going to touch on the adjustable rate mortgage. Have with me an expert, Rich Conlon from Atlantic Coast Mortgage. Rich, why would anyone choose an ARM adjustable rate mortgage? I see a fixed rate mortgage. That's the one that you see most common in the newspaper, online, if people are still reading newspapers for their mortgage rates. But let's do three advantages, the top three advantages of adjustable rate mortgages.
Pushing it. Okay, so I think we can come up with three.
Let's do it.
Obviously, the first and foremost, everybody pretty much knows, you're going to see online anytime you shop, ARM rates are going to be lower than your fixed. So that's obviously one big advantage in terms of a payment perspective. With that lower payment, just leans us into if you are very tight from a loan qualification standpoint with your debt to income ratios. If the 30-year fixed rate pushes you just over the tipping point, you can look at a 15 ARM that we offer, or the 10-1. Usually the 10-1 is pretty close with the 30-year fixed, but that or the 7-1 ARM. So if you're really tight on ratios, you really want the property and want to get into it, and it's your dream house, and the payment is just over the line, an ARM could be the option and the key in success to get you into that house. And then, lastly but not least, ARM programs. This can be pertinent more to our market, Arlington, DC, where you're not necessarily looking at long-term houses. So when you're thinking about something that is going to be a 5 to 7 year, you're just not totally sure, but you're also very sure that it's not going to be a house that you're going to be living in for 30 years. It could be a great tool to take advantage of the lower rate. And then, if you have a 7-1 ARM and you're only going to be here for 5 years, you beat the adjustment period. So take advantage of that lower rate, and then you're out of the house before the adjustment period.
So when you say 7-1 ARM, 10, 15, just for the viewers, for their understanding, what do these terms mean?
So 7-1 ARM, the 7 stands for the first digit in the ARM reading is how long that rate is going to be fixed for the initial period. So if you have a 7-1 ARM, your rate when you go to settlement is going to be fixed for the first 7 years. If it's 10 years, 15, etc. The second digit is the adjustment period. How often does it adjust once after that fixed period ceases? So 7-1, that means in starting year 8, your rate will adjust, and then every year thereafter it will adjust to whatever the current market conditions are. And then we do have other products. I know it's not just ACM provided, but a 5-5 ARM or a 15-15 ARM. 5-5 ARM, so the second digit being 5 means it's only going to adjust every 5 years instead of every year, like the 7-1 and 10-1. The 15-15 is a terrific product from an ARM standpoint, low rate, but it's only going to have one adjustment period because the loan is amortized over 30 years. The first 15 years is fixed, and then it doesn't adjust for only has one adjustment with the 15 year 16, and stays that rate until the full amortization schedule reaches.
Now, who would be a good candidate for an adjustable rate mortgage? Is this someone that's moving out of town? Maybe they're not sure how long they're going to stay in an area. And not to burden you with like 7 different questions, but is it someone who maybe is timing the market where they're going to buy at a low interest rate and then watch the rates jump and see when the best time to sell?
What's
your thoughts?
It's kind of got a wide variety. Initially you would think, first-time home buyers, millennials, because most are probably not buying their dream house at that point. You could say that, but you'll actually see more first-time home buyers directed towards a 30-year fixed or the fixed programs. But So leading into that, I would say if it's kind of buying up, maybe you a couple years into your profession, a promotion, a job raise, or a new job, and a moving up, but maybe not necessarily dream home style. It could also be for the more wealthier people. DC, Arlington, if you're buying, a big house, but also have significant income and assets that you could pay it down sooner. You don't need the full 30 years to pay off the loan. That would be another group of clients and borrowers that
Got it.
fit that.
Let's wrap this up, and then I'm gonna have one final question. So the three things, just to recap, I know the first you said was the lower rate.
Yep.
The second was the DTI. Is that correct?
Yep.
Debt to income. So debt to income, you have more flexible levels.
If you're really close, if you wouldn't qualify with the 30-year fixed payment on a particular house, then you really want the house. And in order to lower to qualify, you need to lower your payment.
Yeah.
Well, lowering the payment would, if you could lower the rate, you're going to lower your principal and interest payment. So lower your overall payment. And like I said, if you're really tight, that could be the difference maker.
And then the third thing?
The third thing is just if it's mobility.
Right.
If it's not your dream house and you don't want to, have a 30-year fixed payment, and you know for sure you're not going to be staying in the house long term, take advantage of the lower rate, the lower payment while you're in the house, and then help by the time.
My final question is, in your experience, how have you seen purchasers mess up an ARM, an adjustable rate mortgage? How have you seen that when you've looked at their paperwork and you're like, man, 10 years ago they bought, 15 years ago, 2 years ago they bought, and you're like, wow, it's gonna be tough to get out of this one, or man, these payments are a lot higher than they should be. What has that person done to get themselves in that position, whether it's them, whether it's the market, whether it's timing? What have they done?
Well, I will say this. I've rarely seen that case, just because of the way rates have been at all-time historic lows in the past, 4 or 5 years. You're typically seeing, most people still, if they're in that ARM period, are writing it out. But not to say that it's never happened. So when someone has come to an adjustment period and their ARM is going to significantly, the payment's going to change, usually we'll run an analysis on a 30-year fixed and refining out into the 30-year fixed. Obviously it has to make sense. If there's no savings involved, then there's no loan, and you're kind of stuck with that. So it's tough to obviously foresee what you're going to be in in the years coming. I don't even know sometimes what I'm going to do this weekend. So
yeah.
It's difficult, but like I said, it's a very rare circumstance, and it's something, if you do come across that, and it's something that people that maybe have purchased with an ARM in the past couple of years, with now the economy, in a recovery, with rates starting to rise. The Fed raised the rates, the federal fund rate, 0.25% last week. So we could see that, for clients that are in the middle or coming soon, that may be something that may become more not so rare.
I've heard rates have been going up for a while now.
Yes,
Is that actually going to happen?
I wish I had that.
That's an unfair question.
At 8 ball, I probably wouldn't be here.
It's a very unfair question. You'd be playing the lottery.
I would. But I would, just some general advice that it's probably going to be on a slower progression, as the thing is, lenders are always just warning people that it can change daily, it can change at the drop of a hat.
Cool.
Yeah, I think when people are applying for a loan, they automatically go the fixed route. Maybe there's already that analysis beforehand and the lender has fronted that, but I think, especially when rates are this low, that you should definitely consider the ARM, at least consider it and not automatically pigeonhole yourself into doing a 30-year fixed. Cool?
Yeah.
Cool. Thank you very much for watching. Until next time, create a productive day. Take care.